Hello, everyone, and welcome to KJH Insights, our monthly podcast. I am Sarah Bull, partner and portfolio manager at KJH Investors. Thank you for joining us today on our podcast, where we provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I have Joel Clark here with me today, CEO of KJ Harrison. Welcome, Joel.
Good morning. How are you?
So, Joel, mid-May, and I can't think of a better time to have this podcast, given the conversations that everyone is having on whether we are heading into a recession or not, and all of the macro news right now. So, help us understand the investment team's thoughts around the economy and market, and maybe provide us with a big picture or broad-based perspective on all the news.
Sure. So, as you mentioned, we're operating in a very macro-driven environment, contrast to sort of micro, which is more business fundamentals. This is more macro, global. We have a president that's trying to change the U.S. economic model in a very chaotic manner. His leadership style is very, very chaotic. As a result, we have questions, as you said, on whether or not we're heading for a recession as a result. So this is an environment that we haven't been here before. And so it's hard to sort of rely on prior playbooks. And so it's quite uncertain. And that's finding its way into the market. And obviously, the biggest worry is the economy. And so if we step back to where we were a month ago when we did this podcast, we had Liberation Day. The market fell to an S&P low of 4,800 from a high of 6,150. So a very dramatic decline. I think Trump and his team was using tariffs to negotiate and was driving a bit of uncertainty into the market and the economy with the hopes of, engineering a bit of a slowdown to get bond yields down. And Powell and the bond market didn't cooperate. And so bond yields reversed on him. He then reversed his stance and put forth a reprieve for 90 days. And we've had a very significant rally in the market. And the number one question is whether or not he's gone too far and there's been damage to the global economy. And so we're in this air pocket at the moment where the market thinks the economy's fine and that further trade talks will lead to trade deals like yesterday with the UK, and off we go. And so I'm just not sure of that. The investment team's not sure of that. So we remain just sort of balanced in our perspective and waiting for the data to confirm one way or another before we take a stronger view. It's just very uncertain. And of course, views change by the day and by the week. So that's sort of where we are today. And I think the next month actually will be very telling as the economic data rolls in if Trump, in fact, has damaged the global economy.
So is the Fed not flinching here because it's hard for them to figure out what the end game is on tariffs, or what's going on in their minds?
Well, the economy hasn't fallen apart yet, and the job market hasn't fallen apart yet. And so there's no need for them to panic yet with dropping bond yields. You had a strong April jobs number, inflation's down, but not falling apart. So it was the uber easy money policies that got us partly into this position to begin with. So they're just not going to drop yields because it's chaotic and play within Trump's games. Trump wants that because he wants the bond market to be the relief valve while he keeps his pedal on the throats of everyone's economy negotiating tariffs. And so there's a bit of an internal tussle for sure, but there just isn't the data to support drastically dropping rates. I mean, the market is discounting a few rate cuts in the back half of the year, but that's where we stand. Now, if all of a sudden we're heading into recession, I'd say the Fed for sure is behind the curve, which they typically are, but Powell says he's going to be data dependent.
And before I ask you questions around that heading into a recession, I just want to go back to something you said about the yields backing up and caught them flat-footed. Explain a little bit more about that for us.
Well, one of their objectives, there's $37 trillion of debt. They have to roll over something like 9 trillion this year. Obviously, the interest burden to the US government is significant. So getting bond yields down and benefits that deficit issue. So their objective was to get rates down. For instance, the 10-year started at 470. In the first few days after Liberation Day, they had the bond yields down to 390. It was going as planned. And then all of a sudden, whoosh, bond yields back up at 450. And the bond market was sort of sniffing potentially. I mean, it's hard to know if other economies were dumping treasuries or if he's gone too far, we're going to have a recession. They're going to have to drop rates and then they're going to have to reignite inflation. Either way, the bond market took off the table what they call that Fed put. And so now it was up to Trump, who was clearly doing damage to the market and the economy, to backtrack. And so that's why he did it.
I think it's so important to understand that story, right? Because it shows that they're not completely in control of the narrative.
No, there's a great line, gravity always wins ultimately, and that's in fact what's happening. You can make decisions and they could be thoughtful, but there could be unintended consequences. At the end of the day, we have immense amounts of debt that's highly costly. That's the burden of every economy, and that isn't going away. So that's a reality, and they have to live with that.
The latest number I heard is that 4% of GDP is actually going towards interest payments on that national debt.
Yeah, it's an insane number. So
Okay, so recession conversation, lots of reports, as you said, corporate earnings season, inflation reports, jobs numbers. What are they telling us about the health of the economy and recession risk? How is the investment team taking all of that in?
yeah. So, recessions generally happen gradually. It's not something that just boom, it's in your face. It's much more of a glacial process. And so I would say we just came through earnings season and the corporate commentary is mixed. I mean, had a pretty good quarter, but the outlook is murky. Some of the tech stocks did really well, some of them didn't. So there's lots of mixed commentary. And so, if all of a sudden there was 7 trade deals and they came to a deal with China, the market's going to look through a month or two or 1 quarter of weakness. If they don't, we are on the path of a slowing economy. And that's why it's a really tricky moment right now as investors is the market is giving credit to things improving and looking through the valley. I'm just not sure if that's the case. I mean, if I'm China, I realize how precarious a position Trump's in. I'm just not going to give him the easy win. Now, on the other hand, China's not in great shape either. So a lot of different chess moves, but it's too early to call if we're going to head into a technical recession.
Yeah, and I think the big thing is earnings reports are backward looking. So really it's more around the forward guidance that we're hearing from corporations, right?
Yeah, and again, a lot of them are pulling guidance. A lot of them there's uncertainty. Again, this is all self-inflicted, so it's totally a wait and see situation, actually.
Yeah, and I'm guessing back to where this is all a lot of this is coming from is it tariffs. So there's probably a lot of consumer buying that's still being reflective. And so we're not actually getting true numbers.
Yeah, I think that's right for sure.
Consumer buying before the tariffs. So, given all of this, as you said, we're in a wait and see, taking a very balanced approach. How are we thinking about balancing asset allocation right now? And what are the thoughts around opportunities given the pullback we've gone through?
Yeah, so, I rely on one of our core values, you can't predict, but you can prepare. We came into this year already fairly balanced, also on the verge of being pretty highly defensive, likely more underweight equities than we've been in a while. And so the majority of the pain this year so far has been on the equity market, credit market has been hanging in there. For instance, our credit strategies are all flat up for the year. So just by being balanced, it's already providing a bit of a cushion to the equity blow. So, and the credit part market's been an attractive place to be. You're still getting those equity like coupons. You obviously have less volatility, and we've been managing capital that way for a few years now. And I think again, potentially credit has another good year, certainly on a relative basis versus equities. So from a positioning perspective, we're well balanced across equity and credit. And then within the equity market, again, we hold those best businesses. We don't trade them. We don't panic. We don't whip the portfolio around based on changes in political views. We own these businesses, and certainly in tough times they tend to go down less, and in good times they go up more because they've taken advantage of weakness. Maybe a competitor goes out, maybe their competitors lose some employees, they steal some employees or customers. So our focus on owning the best businesses run by the best management teams with pristine balance sheets is inherently a defensive posture to begin with for volatile times like today.
Yeah, and I think because we have such a strong investment culture, right? We really know our businesses so well. So we're not just really buying an index blind. And I think in this type of market, that's so important.
Yeah, exactly.
Now, from a Canadian standpoint, we just went through an election. Talk to us a little bit about what that means to Canada. Our dollar has rallied nicely against the US dollar so far to start the year. What's the story and thinking on Canada?
Yeah, so no matter who you voted for, we have a winner. And so we all need to pull together and back who's in charge, and with the hopes of them pulling the country together and accomplishing what needs to be done. I mean, we're in a vulnerable position. We've proven that through negotiations or lack thereof with Trump. And so we got some wood to chop, and we need to recognize the assets that we have in this country and take advantage of them, and all pull together and support industries within Canada, develop industries within Canada, and not be so vulnerable. So I think having certainty at a minimum on who the leader is always a good thing. Certainty is better than uncertainty, and hopefully we make progress. Again, it's a wait and see, and we'll see. So it's good to have that behind us, and I don't think Canada is outperforming the U.S. this year like other global markets. I think that's indicative of potentially a shift to more global commodity led businesses, a different economic environment, potentially more stagflationary. Growth is slow, inflation is still sticky, commodities tend to do well, therefore Canada does well. I think Canada's well positioned going forward. It again comes down to everything hinges on whether or not the US has a recession. And if they have a recession, it's going to be painful for Canada and everywhere globally. So that's the number one question on everyone's mind.
And I guess the mineral resource war, as I'll call it, is largely stemming from the evolution to a digital economy.
Yeah, and underinvestment in most commodities for decades. They were in a very steep bear market, destroyed a lot of capital. Now, just the amount of capital, the time, the permitting process to get stuff out of the ground can take almost a decade. So we are undersupplied on almost all commodities, and this world is still growing. And so there's also a bit of a strategic like countries who owns the commodities can access them really matters. That these commodities find themselves into many parts as it relates to electrification of the world.
And in this game of catch up on critical materials for the world, Canada really needs to be at the center of it. So it's an exciting time for our country.
Yeah.
Well, Joel, like always, we could probably talk a lot longer, but we receive a lot of positive feedback from our listeners on the length of these episodes. So I guess that means we should probably wrap things up here. But anything else you want to touch on before we close up this month?
No, I think from an investment perspective, this is a good time to keep balance, keep diversified, not try to make any big calls. We're in uncertain times. No one knows the outcome. Haven't been here before. Just let the chips fall and act accordingly. This isn't a time to be concentrated and make big bets. This is a time to just be careful, be mindful, and watch things play out over the next few months.
Okay, well, great. Thanks, Joel. I think that was a really clear summary of the macro environment. And as I always say, our goal with this podcast is to cut through the noise and really focus on what matters and how the investment team is thinking about the market. So let's end here. Thank you very much to our listeners for joining in today. We'll be back next month with another issue of our KJH Insights podcast. Wishing everyone a happy spring. And as a reminder, if you have any questions about your portfolio, please reach out to us at any time. We'll continue to provide you with market commentaries on our website at kjharrison.com. So we look forward to speaking to you next month, and take care.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.